Hello everyone, this is Brian Rezny, host of the Rezny Wealth Report. Of course, we've got a great show for you again today. We're going to talk a lot about the markets. We're talking about a small correction in the markets. Is it going to lead to a major correction of over 50%? I'm going to talk a little bit about that today, but more importantly, I'm going to take your calls and your questions. If you're concerned about your portfolio, if the advice you're getting is less than advice, if you're realizing conflicts of interest with your brokerage firm, your bank, or your insurance agent are working against your retirement, and you're really getting no advice at all, call us in the studio. I'll be more than happy to take your calls and answer your questions. You can also send me email questions to Brian Rezny at ReznyWealth.com. Of course, all questions are answered on our TV show, and our number's at the bottom of the screen. You can also visit my website, ReznyWealth.com. I wanted to talk a little bit today about investment strategy. And also, how does an investor actually protect their portfolio? Not from these little bounces, and I want to give you some statistical information. Unfortunately, most investors falsely believe the only investment that goes down is the stock market. Well, folks, I'm here to tell you the bond market also goes down. And in fact, last year, if I look at 10-year treasuries or 30-year government treasuries, these investments went down between 8 and 15% negative last year. Now, treasuries, U.S. treasuries, are regarded as one of the safest investments in the world, but that doesn't mean they can't go down in value. The bottom line is this: all investment assets, whether it's real estate, oil, gold, the stock market, bonds, or anything in the middle, can go up and down and will have small short-term corrections on its way to hopefully a long-term trend. Now, I firmly continue to believe that bonds are going to be one of the worst places for investors to be over the next 3 to 5 years. Maybe not the next month or 3 months, but clearly 2013 taught bond investors this: bonds can go down, and they can go down a lot. I firmly believe where interest rates have come off at 3% back down around 2.6, I think this is a great opportunity for those of you investors who've been getting the wrong advice about bonds. It's time to reduce your bond exposure and shorten your maturity. The problem with most investors is this: your portfolio is one-sided, and if it's not one-sided, it's lopsided. Let me talk about what that means. When you're one-sided, you're typically in one asset category. I can tell you from managing money 28 years, and we have new potential clients coming to our offices throughout Florida all the time. If I look when a client comes in, or potential client, and I look at their broker statements from the big and small brokerage firms or these independent fee-based advisors or commission advisors, it's the same thing over and over. One-sided means you're typically all in equities or equity in mutual funds or equity investments, or you're all in bonds and bond-related in the U.S. That's one-sided. So if equities don't do well, your whole portfolio doesn't do well. If bonds don't do well, your whole portfolio doesn't do well. Lopsided usually means that you basically have a higher allocation, let's say to bonds versus equities, and you only look at those two areas. Remember, folks, the only place to invest is, first off, not just the U.S., and it's not just stock and bond-related investments. There are many investment categories that are not correlated, meaning they move in a different direction than the stock market or the bond market. What you need to do as an investor is you need an investment strategy that's adaptive. Unfortunately, this is what most of you have when you open your broker statement. You're doing something called asset allocation. Asset allocation, or we call it at our firm the failed Wall Street pie, is basically easy to understand. Because most of these firms really don't manage your money, they just want to put you in a whole bunch of different things, and it tends to be stock and bond mutual funds. So you might own 20 stock and bond mutual funds, but basically it's the same thing. It's just spread around this pie. When things go bad in the equity market, you, again, are lopsided. You still own equities all the way down in a recession. Now that interest rates are back at this low over the last 10 or 20 years, and investors who overloaded the boat in bonds, again, have too much money in bonds. So as interest rates rise, bond values go down. This is going to hurt your supposed asset allocation that's there to protect you. At the end of the day, asset allocation or over-diversification is basically a lack of a real investment strategy, which includes risk management, or when do you sell any investment, not just the stock market, but all assets. And your portfolio needs to be able to look at all investment assets, but only include those assets that belong in your portfolio today. That's why we believe you need an adaptive investment strategy to guide your retirement and your portfolio. Adaptive means as changing conditions happen in the economy, interest rates, housing, oil, whatever investment there is, your portfolio can freely migrate into those assets that are appropriate and sell the assets that are not appropriate as they get weak, not after they've dropped 40 or 50%. The problem with most investors, again, they own a pie. That pie basically is always in those assets, and it always stays in those assets, even when you're not supposed to be in stocks and when you're not supposed to be in bonds. Again, if you have a question about your portfolio, if your portfolio is suffering from asset allocation, that failed Wall Street pie, and you're realizing a more active, adaptive strategy is more important than ever, visit my website. You'll learn what we're talking about and how risk management is the most important part of money management. Not to alleviate these little bumps in the road, but the catastrophic 20, 30, 40% drawdowns of your investment capital in the next recession. Go to ReznyWealth.com right now. You can sign up for a consultation with my firm. You can also download any of our free reports. One of our hardest hitting reports is how to avoid outliving your money during retirement. Sue in Naples, Florida. Why is my advisor pushing an equity index annuity for my IRA? I know you don't like them. Why should I avoid them? Sue, great question. Over half of the new potential clients that come into our offices every single day have been sold 1 to 4 annuities. I've had people come in that had 6, 7 annuities. The person that's selling an equity index annuity is no more than an insurance salesman, probably using a fancy title, probably invited you to a free steak dinner to then cram down one of the most complex, most ridiculous, hideous, expense-ridden investments, these equity index annuities that do not belong in your portfolio. These things are toxic in our opinion. They're expensive. Your chance of making any meaningful return is slim to none. You insanely lock your money up, often as long as 22 years, with surrender penalties often as high as 20% to get your own money out. Do not put your money into an equity index annuity or any annuity, and certainly you would never put an IRA into annuity because your IRA is already tax deferred. You're clearly working with an insurance salesman who is interested in lining his pockets or hers versus what's best for your portfolio. I would suggest you go to my website, ReznyWealth.com, and you can download for free our report, Why Annuities Are Dangerous to Your Wealth and Your Retirement. You will learn the facts about these toxic products and why you need to avoid these. I would also call my firm for a consultation. There is a difference, and we invite you to experience it. Bill in Fort Myers, Florida. The market is selling off. What are you doing? Well, I'll tell you what we're doing. We follow a strict strategy at Rezny Wealth Management, and we don't panic. We run a strict strategy called relative strength. So like when I talked earlier, we look at all assets around the world, all asset categories, not just stock, not just bond. We don't own all those in the portfolio. We have those, let's say, in our corral. We rank those on a proprietary system, and we own relatively stronger assets in an uptrend. As that trend starts to break and they get weak and they don't belong in the portfolio, they're then sold and replaced. Sometimes that means raising cash. We have, as of late, raised a considerable amount of cash within our client portfolios. So what we're doing and what you're doing is probably two different things. We're a money manager. We believe risk management is extremely important. We're not concerned about little bumps in the road. Remember, 2 to 5% bumps happen in almost every asset category routinely throughout the year. So again, small corrections, small downward trends, not a big issue. What we want to do is avoid these 20, 30, 40% catastrophes that you need to avoid for the safety and security of your portfolio. So we have raised some cash. Our positions can change at any time. We have gotten more conservative in our assets that we own simply because those assets that are getting sold off became weaker and it fell out of our top ranking. Do you have a strategy to reduce risk in your portfolio? If you don't, call my firm, Rezny Wealth Management. The number's at the bottom of the screen. Lou in Naples, Florida. I own 40% of my portfolio in gold. What are your thoughts about gold? Lou, that's a great question. We continue to get a lot of calls on gold. We have, as a firm, not owned gold since the end of 2012. If you remember 2013, gold dropped around 26, 28%. We avoided all that catastrophic loss because gold started getting weak at the end of 2012. We sold it in 2012 and basically reduced our position or eliminated it because, again, we run a strict investment strategy. What I'm going to tell you is this: gold is starting to come up the rankings a little bit, but having 40% of your money in gold, that's a little crazy. I would encourage you not to have a max position in gold, probably any more than 25% at the most, and that's assuming you run a strict strategy on risk management. I don't know how long you've owned gold, but if you've owned it last year, your portfolio has got to be a disaster. Why did you buy gold? How does gold and your position fit in your strategy? And what causes you to either add more or to sell it to reduce risk? I'm guessing that you do not have an investment strategy you follow, and like a lot of people that were either sold gold or bought gold, they bought it because they thought the world was coming to an end and they thought gold was a safe haven. Gold is like any other investment asset. It can go up, and as you've seen, it can go down, and quite a bit in your portfolio. Bob in Fort Myers, Florida. I have a $1 million portfolio. I need income. What are your thoughts? Bob, first off, regardless if you need growth or income, as a firm, I always look at what's called total return. That's the gain of the asset or the growth and the income that you can derive from the portfolio. You put them together, that's total return. So if you need income, you don't have to just go to income-oriented investments for income. You could have some growth investments that you could take that growth off each quarter or each year for income, and you could also have some income investments that help buffer the storm. At the end of the day, you need to have a strategy that's adaptive, that can change to conditions when investment assets are not appropriate in your portfolio and know when to sell. So again, I would look at a total return portfolio. That's what we provide with our clients at Rezny Wealth Management, because a lot of our clients do need income, but if you only look at income-oriented investments, you're going to miss the boat, because at the low interest rates we have today, most investors are going to make very little and really have a good chance of losing a lot of money if you're chasing yield, especially bonds, bond funds, and closed-end mutual funds. Jan in Fort Myers, Florida. My portfolio lost 8% in 2013. I own all bond mutual funds. I thought bonds are safe. What happened? What would you do? Jan, great question. Jan, you're like a lot of investors who unfortunately falsely believe that bonds only go up. Remember, and I've had this question a lot, bonds can go down a lot. 10 to 30-year treasuries, government treasuries, the safest perceived investment in the world, dropped last year between 8 and 15% down. Your bond portfolio, obviously you lost 8% last year, even though other asset categories were up 10 and 15 and 20%. The bottom line is this, Jan, you own too many bonds and bond funds. I don't know what your strategy is, and I don't know who's giving you this poor advice. I would firmly suggest you call my office, schedule an appointment, either our Naples office or a Fort Myers, but it would really benefit you to sit down with a real money management firm, let us evaluate each one of these bond positions or bond mutual funds you own. I can firmly feel right now you are overweighted in bonds, and you could have another year like you had last year, but unfortunately that can continue for the next 3 to 5 years as the economy gets better and interest rates go up. Your bonds will keep going down. I'm going to take a short break. I'll be back with your calls, your questions. Please visit my website, ReznyWealth.com. Download those free reports. You'll be glad you did. I'll be right back. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hopefully you're enjoying today's show. I'm Brian Rezny, of course, host of this program. By the way, every Sunday live, I do a live radio show throughout the state of Florida. You can also catch it on the internet. It starts Sunday morning, 10 a.m. Eastern to noon. It's 2 hours long. We take a lot of calls and questions. You can send me an email question at brianrezny@reznywealth.com. You can see the spelling of my name. Again, go to my website, reznywealth.com. I would love to hear from you. Listen to my show this Sunday, again, 10 to noon. If you want to listen to the stations and availability, again, that is listed on our website. Michael in Florida. I was initially taken to the cleaners by a smooth-talking brokerage lady advisor who actually talked me into buying 6 annuities many years ago. Can you advise me on what I should do with these annuities in order to lessen my tax burden once I decide to withdraw? Michael, the bottom line is this. You probably did not read the fine print. I can tell you, I've been managing money for 28 years. Half the people that come into our office that hire my firm have been sold 1 to 4 annuities. You were sold 6, and I use the word you were sold. You were sold typically a bag of goods or taken to the woodshed. Smooth talker, yes. Most of these people that sell annuities work under suitability. Legally, they don't work in your best interest because they're working in a commission structure. So unfortunately, a lot of these people lie, tell half-truths, tell you stuff that you want to hear in order to sell you a high commission product with a big back-end surrender. Yes, you were sold by a slick saleswoman or a slick salesman. Avoid annuities at all costs. I would suggest you go to my website, reznywealth.com, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. But what can you do to reduce the tax burden? Nothing. The problem with annuities, and I'm going to also talk about how they're sold to you, is you were probably sold when you put the money in the annuity. When it does grow, all that income grows tax deferred. You're supposed to save some money in taxes. What that salesperson didn't tell you, when you take the money out, not only are you going to pay taxes, but you could be paying taxes at twice the rate of capital gains and dividend rates because you've got pent up and that money comes out as ordinary income, not at capital gain rates. So most people that own annuities, not only were you taken to the woodshed on bad returns, you were taken to the woodshed on huge expenses against your money, which of course lessens your returns. And if you did make money, when you pull it out, you get to give up to twice as much in taxation. I hate to tell you, that was a huge mistake. Don't make it again. Go to my website, reznywealth.com, download that free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Read it. Understand it. I give you the skinny on annuities, why they're dangerous, and why you need to avoid them. You really need to look at each one of these annuities at this point and decide, is it appropriate to get rid of these things? What's the surrender cost? What's the annual cost? And does it make sense to get rid of these things? Get your portfolio realigned that's better for you instead of the person who sold you. Again, the woodshed experience on the annuity. Carol in Florida, the markets were down quite a bit in the past week. I know they call this a correction. What exactly is a correction and what triggers it? Thank you, love your show. Carol, thanks for the nice comment. What triggers a correction? There's all kinds of stuff. A correction basically is typically when an asset category, not just the stock market, but the bond market or gold or real estate. When usually an asset category drops about 10% in value, that's considered a correction. Most markets are currently not in a correction, and some are. There's areas like, as an example, gold has been in a long-term correction well over a couple years now. It's actually off about 35 to 40% from its high. So things can correct. And what causes it? Typically excess or short-term news. If I look specifically at the stock market, we've had a lot of news coming from the emerging markets. We've had a lot of news coming from the United States. Generally speaking, our economy in the U.S. is getting slowly better, and nothing goes straight up. If I look at the U.S. market last year, it went up 7, 8, 9, 10 steps, and it's time to come down 1 or 2. That's healthy. We are watching a lot of our indicators. We've already raised some cash. Our positions can change at any time, and there could be a point that we may go to a 100% cash position and or sell all of our equity positions or any position in our portfolio. Again, risk management is important. I'm not panicking, and I don't suggest you do, but again, what's your strategy? How's your money being managed? And how do you reduce the severe correction risk, which is when things really get bad in a slowdown, and you could see assets drop 20, 30, 40%. So far, this is mild. It could get worse. And again, you have to make a decision when you're going to reduce risk. We've already done some of that within our client portfolios. Larry in Boca Raton, is it possible to put money in our IRA account after retirement? Larry, great question. You can put money in an IRA after retirement if you have earned income. So if you don't have a job, if you're not working part-time at Walmart as a greeter or Publix or whatever the store is, you don't have earned income. If you don't have earned income, no, you cannot add contributions to an IRA account after retirement. I have a lot of clients that get bored in retirement and they go back to work part-time. Yes, at that point, depending on your situation, you can add money at that point, but you need earned income, not income from a pension, not income from Social Security or investment income. It has to be actual earned income from a job responsibility. Barbara in Naples, Florida, do you still hold a position in PFF? Barbara, great question. A PFF is the iShares Preferred. This is a basket of about 80 to 100 preferred stocks. It's a hybrid of bonds, between bonds and stocks in a portfolio. No, we do not own PFF currently. We actually sold it a long time ago, well into 2013. The reason we sold it, because rates bottomed and they started moving back up. And PFF was starting to get relatively weak, and it hit a trigger within our sell signals to sell it. The problem that I see with PFF right now is now that we've gone full cycle, we're kind of at that bottom of interest rates and they're starting to move up, preferred stocks or bonds, or however you want to phrase it, are usually very long in maturity. This is where you do not want to be if the economy is getting better and rates are moving up. Remember, preferreds and generally speaking, fixed income investments or bonds go up when rates go down and basically go down when rates go up. So it's a teeter-totter. The farther you are at the end of the teeter-totter, the more movement you get up or down in your portfolio. Preferreds typically are long dated, often 20 or 30 years out, which is really long in the curve. I would be avoiding long-dated bonds, mutual funds, and I also would be avoiding preferreds at this point in time. Brian in Marco Island, Florida. If everyone believes small cap index funds will outperform and have better results, won't everyone invest in them until it becomes overvalued and not such an amazing deal anymore? Brian, that's a great question. In fact, when we look at positions, one of the things, statistically speaking, again, this is no guarantee to the future, but small caps have historically, over various time frames, outperformed mid cap, which has outperformed large cap. Small cap companies are where large cap companies used to be. And statistically, because small companies can grow earnings faster and revenues, and they can also be bought out by mid and large companies, they have typically outperformed for that reason. So just because people buy small cap doesn't mean that they're going to underperform or outperform, but the reasons why they have outperformed in the past, as long as those are still valid, which I believe they are, and if we have a positive uptrend and the economy is growing, I firmly believe part of your portfolio, if again it fits into your strategy, small cap and mid cap to me are a great opportunity versus large cap. The problem that I see often with investors is when I look at when somebody comes into our office, a new client, they've got the pie. If they're working with a Wall Street firm or most of these firms, they basically are in the pie, and most of the pie is always in large cap. So you're missing out, in my opinion, on small and mid. I believe there's very few people in small and mid cap indexes or investments, and most people gravitate to what they've heard about, and that's why often they don't do all that well. I think all investment assets should be part of the stable that you look at and own those pieces or those horses in the stable that make sense today. Dean in Fort Myers, Florida. My portfolio approximately $1.2 million. I'm invested in all bond mutual funds, 12 in total. Lost approximately 4% in 2013. I thought bonds are safe. What am I missing? What would you recommend for income? Dean, you're missing a lot. Number one, you are falsely believing that bonds only go up and they don't go down. In fact, bonds, depending on interest rates, depending on the cycle we're in, bonds can be as volatile as different parts of the equity market or stock market. So what I look at is this. If all your money's in obviously bonds and you lost 4%, you throw inflation in there of 3% last year, you're down 7% net of inflation. And that's before taxes. At the end of the day, having all your money in bonds makes 0 sense at all. I don't know who's giving you that recommendation. Why aren't you looking at other asset categories that are appropriate? I would firmly suggest you call our office. Let's look at the portfolio you own and let us help you manage that portfolio so you can get income and growth, which you're going to need both. There's not one savior for income that I'm going to point you to. It sounds to me like you have no strategy, you've overloaded the boat in bonds, and unfortunately, if rates keep moving up, you could lose another 4% or who knows 10% this year with what you're doing currently in your portfolio. Cam in Bonita Springs, what do you think of the slowing growth of emerging markets? Cam, great question. Emerging markets are slowing. They're slowing from 10% GDP levels down to 7 and 6 and 5. Still very good. There's always going to be headwinds in any economy. Emerging markets provide great opportunity. We currently don't own anything in emerging markets. Our positions can change at any time because they have been weaker. But generally speaking, when that trend changes and if they rank higher in our performance system, we could add those back. Right now, they've been weak and they look like they're in a downtrend, so I would want to avoid them until that changes. But the economies in most emerging markets are doing quite well, but you're going to have a little bit more short-term volatility with those. Folks, I'm just about out of time. If you're concerned about your portfolio, if the advice you're getting is less than advice, if you want to work with a real firm who works as a fee-only money management fiduciary, who works legally in your best interest, risk management is a big, important part of how we manage portfolios. Call my firm for a consultation. The number's at the bottom of the screen. You can also visit my website, reznywealth.com. And of course, we've got some upcoming workshops throughout Florida. Call my office for a consultation, and until next week, make sure you have yourself a safe and profitable week.